is there, what month are we in? February? There should be, right?
Yeah,
I yeah,
they if you go deep in the mountains, they've got it all year round. I'm fairly sure, just off a baseline.
Interesting. I don't know where Dow is. Where I was going to wait for Dow, but we might go ahead and get started and let him catch up. But yeah, thank you everybody for coming. Another episode of Crypto and Coffee. Just a friendly reminder, nothing said here is financial advice, strictly for educational and entertainment purposes at times. But yeah, I do want to just let Queen and Julian maybe give a quick intro of who you are, and then we'll get started. Just if you want to just quickly say your name and what your role is at Swivel.
Wartooth, you want to go
Yeah, you
first?
got it. So I'll explain just a little bit about Swivel. I'm the marketing there. Excuse me, I'm the marketing lead there. I'm Queen Wartooth. But Swivel, who I work for, is an order book-based fixed rate lending and yield speculation protocol that facilitates the exchange of tokenized yield. And that's a mouthful. So what does it mean? It means we take a yield-bearing staking or lending asset like ETH, and we split it into what's called principal tokens and yield tokens. Principal tokens and yield tokens are exchanged on an optimized hybrid on and off-chain order book. And for lenders and stakers, what that means is you get better rates and increased liquidity depth. And for liquidity providers, you get to avoid losses associated with derivative AMMs, like those that deal with toxic flow. And for users like you and me, stakers and lenders reduce their risks. You can hedge your operational costs, long rates, and transaction demand. So that's a little bit about Swivel, and I'll let Julian introduce himself, who is the founder.
Welcome. Thank you, Queen, and welcome, Julian.
Howdy, howdy. Yeah, as Wartooth gave me a nice intro to an extent already. I'm the founder at Swivel, and I mean, generally speaking, we work on a lot of cool things. Um, I think the largest thing that we generally try to talk about is a lot of the stuff that is broken in DeFi, and all of the things that we try to do to generally fix it. So, more generically speaking, beyond just, of course, like the idea that we are trying to tokenize a lot of these more unique sources of yield in DeFi, we're trying to really make a lot of them accessible for regular people, and more importantly, a lot of like the cool applications that people have been shilling for literally years, right? There really hasn't been much built in DeFi beyond the first layer, and we at Swivel and Illuminate, who's also in the crowd there, are trying to really enable people to go to the next level and actually use DeFi to the degree that people have been saying it's supposed to be used. And yeah, I guess that's a quick little intro.
Yeah, that's awesome. And really quick, Dow did join us. Dow is a DeFi DJ, if you want to call him. So I'm happy to have him here because some of this stuff definitely goes over my head. So I rely on other people in the space to help me out. But yeah, so fixed DeFi, Julian. So how did you end up here? Like, do you have a finance background? Before we get into the nitty gritty, like, how did you end up starting Swivel Finance?
I think it just kind of like the easiest way to say it is it just kind of happened to an extent. And I think that's the case for a lot of people that really are in the positions they are now in crypto because they were just here and they had been here in crypto consistently for a long time. Right. So for me, I mean, to answer your question directly, there was no real direct background within finance at all, other than getting engaged into crypto and wanting to create some more advanced financial tooling that hadn't existed at the time. So I actually had previously created a project called Nescience, which was a portfolio rebalancing tool. You could hook it up into any centralized exchange, and it would allow you to rebalance your portfolio and do some pretty cool stuff at a basic level. The differentiating factor of my product was that it was all client based, so you didn't have to trust some random web server or like some random website, more specifically, with your API keys, which is kind of sketchy. And actually, one of the main competitors at the time was 3 Commas. I'm not sure if anyone's familiar with this, but there's still ongoing John right now because 3 Commas leaked everyone's API keys and people lost millions of dollars. So I'm validated now, but realistically, I made no money on that at the time. So even beyond that, I had a degree in psychology, And at the time, I was really sustaining myself by playing video games. That doesn't really hook in that directly, but yeah, my background was in playing MOBAs, like League of Legends and Heroes of the Storm. I guess so. So origin story of Swivel is kind of where we're getting with that. I don't want to just like diatribe, but is that where I should go with it?
Yeah. Go ahead.
Cool. Yeah. So Swivel initially was just like a really crappy hackathon project. I in 2020 was going with Nescience to going to ETH Denver 2020. So this upcoming month will be our 3rd-year anniversary, and the initial idea was just to do a really basic hackathon, get some initial understanding of Solidity, DeFi, etc., and honestly to try to find some funding and support for the previous project, which wasn't going so hot at the time. It was the middle of the bear market. So it was actually at ETH Denver the day that Ethereum hit $80 that we started the project. And the initial idea was just a basic time lock around Compound, where you could lock some money up. It would earn interest in Compound until however long you'd like, and in that way it would act kind of like a shitty trust fund that you could give to like a loved one or somebody, and it would be guaranteed to earn interest until some future date, where they could finally withdraw it. And what I realized during this process, or actually let me get more clear, we didn't quite finish the whole hackathon. What the result was that we got like 60% of the way there, and it was about 4 a.m. and we had to decide between finishing the whole thing or just submitting it to what was known as the idea track. And that would give us complete carte blanche to lie about our initial intention. So then we got to the drawing board of what really is the use case here. And it became very, very clear that a better thing than just locking up the capital and giving it to somebody would be to make that locked money in Compound tradable. And what you actually have the second you do that already is something very similar to an interest rate swap in traditional finance, where one party essentially owns the actual capital that was committed, right? And the other gets to purchase all of the interest that's being generated in Compound while it's locked up. So in that way, you have one person that's able to very easily, just once you make that tradable, speculate that, hey, rates could go up, right? We can create a vibrant interest rate speculation market. And at the other end, it's just the same counterparty, somebody that just wants to get a fixed rate. So it made a lot of sense at the time. Compound's rates were swinging wildly from 4% to 15% on a monthly basis. And it just was very, very clear that was going to be giving me a lot more traction than the previous project at Nescience. That said, it didn't really for maybe 8 months or so, about a year. It was still the bear market, and it wasn't until I went through Gitcoin kernel, where I currently lead the DeFi stuff now. But I went through Gitcoin kernel, and it was with their initial traction that it was Imran Khan and Zhao, who now lead DeFi Alliance, that came in and immediately they came to the DeFi demo day, saw my demo, and left and sent me an email within 2 minutes and said they were in for a check. So
Wow.
that was pretty much it. I think I owed them more than anyone a lot, because they gave me the legitimacy to go from, I don't know, what I'd like to think. I think everyone thinks they're a degen, right? But I was a nobody that just played video games until they sent me a check for the most part. So.
Yeah, it's good. I think, and this is my personal opinion, a lot of the best products come from people that are in the space that see an issue and they want to find a way to fix it. So I totally agree. I think sometimes we see the word degen as a bad term, but I see it as a good term. It's people who are deep in the weeds of this space and are have a good understanding. But
Definitely.
yeah, any comments?
I was just saying, definitely crypto native.
Yeah, and it's I think it's just funny, at least. I mean, I'm giving myself a little bit of shit for not having much of a background. But in reality, there's a lot of founders and a lot of investors that are ex-pro video game players or ex poker players, essentially just gamers in general. So in reality, I had a perfect background to get funding in crypto. I think it's pretty unique. You couldn't get that anywhere else for sure.
Yeah, you can't be a DJ if you don't play video games, man. Like that's your bachelor in understanding all the game mechanics, the incentives, your opponents, and the NPC. So I actually think it's a great background. So I'm sorry I missed out the early part. And I think I think there was a number mentioned, 55 trillion. It was that the number that you guys pointed for the interest rate swap market.
Yeah, it's massive. Right. The traditional interest rate swap market it does 55 plus trillion a year. And I think that's even a year or two old. So it's probably like their data hasn't been reported yet for the recent years. Most likely it's increased even further. So obviously that's a huge market. It's hard for us to say exactly what our acquirable market is there. But even when you restrict it to crypto assets and to DeFi, which is not very, ambitious, there's a massive market there. And as well, I mean, this is something I'm sure we'll get into later in the conversation. There's so many things that you can do in DeFi once you actually build these initial layers that it actually expands the market from just like lending to a lot of other markets, right? Like the biggest thing that I'll likely talk about is options, where of course options markets have become increasingly vibrant over recent years, and in reality people can do a lot of things in DeFi that just give you better premiums than you can get in any traditional venue. So like for me, these sorts of things where you can just get better prices on the exact same asset that you would buy on a centralized exchange, right? That's what will actually onboard people. And also, that's also a massive onboarding market for us. So hopefully that can be part of our TAM too.
Man, that's a great explanation. And I heard that number somewhere before. So yeah, that's a massive opportunity. And yes, Jess, I'm super excited we're talking about DeFi. That's my, I feel like a kid at Christmas. We're finally talking about the stuff that really matters, at least for me. But just to give a context, man, because I think this conversation we definitely can deep dive is, in my opinion, what people are building in DeFi is they look at traditional finance and they look at the core primitives, right? Whether it's lending, trading, as you mentioned, options, things like that. You kind of look at them as financial primitives, and we can map all of them into DeFi, into actual smart contract, and make them even better because we can align the incentives better. A lot of times in traditional finance, things are opaque, they're really complex, and they're like outdated. In DeFi, everything is on chain, so it's transparent and people can build on top of each other without asking for permission. You don't have to ask for access to API to JP Morgan's data to build on top of it. So I think Swivel comes into that picture and they're saying, okay, well, cool, we got some basic building blocks, right? We got lending through Aave, we have exchange through Uniswap and so on and so on. But in traditional finance, derivatives are massive. They're a lot more bigger than spot trading, maybe like 10x or 20x. And one of the most important financial primitives in derivatives is actually interest swap. So that's the limit of my understanding. My question to you, Julian, is why is it so important for traditional finance to have interest swap? Like, who's participating in that activity, and why is this such a big part of traditional finance?
So I think like you're right in that everything ends up being mapped across in many ways, and it's really important to just like it actually helps me to go the other way around. I wasn't a big traditional finance person, so I actually understand traditional finance in context of a lot of the mechanics you see in DeFi. So to answer your question, then a lot of people when they're getting a loan, for example, you're getting a loan from the bank. You know by now that getting a variable rate loan is a risky thing to do. Most likely at this point, you've heard stories of a family friend or somebody getting screwed in 2008 on a variable loan, or any instance, even recent periods, where of course the rates have increased massively and they're underwater. So for that reason, of course, every real consumer wants to get a fixed rate. However, something people don't really realize is that for the most part, fixed rates don't actually exist. And like, let me explain what I mean there.
Yeah,
And that,
explain that, please.
yeah, like when you're getting a fixed rate from a bank, well, they aren't just like getting that money from nowhere, right? They are generally speaking borrowing it from their lenders, like from you if you're also using them, and they're paying out like 0.5% or whatever crappy rate. or they're borrowing it from another institution and they themselves are paying a variable rate. So then they're left in a situation where all they're doing is actually they're speculating, hey, I'm going to pay this variable rate, and then pay out a way lower fixed rate, and then I don't really have to actually worry about any differential in there because there is some amount of statistical arbitrage between the two. The issue is whenever you take on a fixed rate, people pay you a fixed rate while you're paying yourself a variable. Well, of course, you might not, like if there's a massive change in the market, be able to continue to stay above water for your payments there, right? If your variable payment goes up and you're only earning $500 a month, you might be in a bad spot. So for that reason, a lot of people need to then go into an interest rate swap, where it ends up allowing one user to speculate, hey, if the rates go up, I can profit. And then that way, of course, the bank themselves are able to offer the ability to get a fixed rate of them for the banks are able to offer fixed rates for consumers without actually themselves taking on risk. They then have just done a simple agreement with another party to speculate on the rate itself. And with that, they're able to match the massive size of whatever consumer loans that they put out. So what I'm getting at there is you don't actually have a fixed rate there at all. You have an institution that is hedging away their variable risk, and they do that through an interest rate swap. So that the same exact thing exists in crypto, right? At the end of the day, you don't really have directly fixed rates for the most part. There are a couple protocols out there that do this directly, but you have people that are using a derivative of the variable rate and trading it around to create fixed rates on top of it. And even there's a couple other protocols that do direct fixed rates. Their liquidity providers are expected themselves to have hedged their risks there too, right? Anybody that is in a situation where they're providing liquidity to a fixed rate has a cost of funding themselves, has to pay it off, and in order to do so, they need to hedge away their risk. So obviously, traditionally, everyone's getting loans, so this is a way larger market. We'd like to start seeing some more just natural activity outside of leverage within DeFi. For now, that isn't the case, but it's definitely to come.
Julian, I can see what you're saying. I do actually come from the traditional finance background, so I do understand what you're saying. To the consumer, it still is a fixed rate to them just for that simple process. But I do absolutely see what you're saying. But I did want to go ahead and agree with you also on people with variable rates that got screwed. And there were a lot that were in mortgages that did as well when they did ARMs. Those used to be big, and for their mortgages, that really messed a lot of people up. But I did want to say this before I forget. Don't sell yourself short on not having a traditional finance background, because even in the traditional finance world, there are so many people, half if not more, that don't even come from the traditional finance background. So you're not alone, even in this space.
Yeah, and I mean, just at a basic level, there's going to be a lot of people that always make this mistake. And if you're just taking on a variable loan and you're a small size, at the end of the day, you're going to get screwed because whatever institution out there has access to swaps at a massive degree, has better pricing, has an understanding of it better than you, and that changes with crypto, right? Like. Everybody at this point has access to swaps through Swivel. An example actually could just directly be like if you are trying to pay off ETH transactions, you can either fix you can stake at a fixed rate with Swivel. So that's one nice thing. We're offering like 7%. Just a quick chill there. But then on the other side of it, right, if you are worried about paying off your transactions over the next couple months in the same way that you'd be worried about paying off a variable rate loan, then, well, it makes a lot of sense to long the staking rate. And in that way, if your variable costs go up, well, you're making money on your long position. And it's the exact same thing as an interest rate swap traditionally, where people are trying to avoid like going underwater on their loan, right? Imagine if in 2008, everyone could be like, oh, wait, holy shit, I'm actually about to get screwed. And, maybe just drop a large percentage of their principal to enter into a swap and avoid actual issues. This is the sort of infrastructure we hope is available now that really just wasn't in the past.
Right. And in traditional terms, I would call that, for people that are familiar with traditional, it would be like a loan modification. That's pretty much what you're describing.
Sure. Yeah, yeah. Just getting out of whatever fixed or variable agreement, and in the most efficient way. Um, I think that's one thing that DeFi offers at a core level that just people don't really get yet, is that the core infrastructure level is available to everybody. Versus in traditional finance, right? Like these swaps, especially at a reasonable price, are just not available unless you're a massive institution. If you're trying to, like I was saying before with options, if you're trying to back an option with a bond, which would be the same thing as like backing an option with a fixed rate lending position, you just cannot do it unless you are insanely massive institutions. And that kind of precludes almost everybody from getting good deals on any of their loans and any of their mortgages these days. It's something that like there will be outsized effects on with time.
And I'm super excited what you guys are building on, because I think it's when you mentioned loans, right? In my head, I was thinking more in terms of yield-bearing asset, like stake ETH or any form of like asset that gives you yield, right? People have liquidity LP positions that earn things. So, like in traditional finance, I guess like this is really focused towards loan, but in crypto, we can even add other use cases where people are getting a variable rate, and it in my words, right? I'm trying to simplify it in my head, right? It sounds like it's a marketplace for or between savers and maybe gamblers, right? Like depending on your tolerance for risk, if you're more of a saver and you have this asset that gives you this variable yield, you're thinking, hey, is there a way for me to get the fixed rate on top of it? Maybe I can reduce the yield that I'm getting, but at least it's fixed, and then I don't have to worry about it. It's fixed and it's there for a long term. But then on the other side of the market, maybe some people that think that the market is going to go up or go down, and they think that the yields are going to go up. So they actually get access to this yield, maybe at a cheaper value that they would have otherwise. But also because you're separating this yield bearing asset, I can just take the yield and just buy that as opposed to having to buy the entire asset. So it sounds like you're providing this marketplace for potentially the savers. In my head, it would be the institutions that just want to have maybe like access to crypto that's very fixed and predictable, and matches their risk model or risk tolerance. And then the rest of us, the DGens and DeFi, are looking for a 10x and 20x that want to gamble and get leveraged position. We now get access to this asset that in traditional finance, as you were just saying, we don't get access to because we're not big enough.
Yeah, like I think the best example is likely with staked ETH, where on one end you have the ability to stake at a fixed rate. That's a really easy to explain use case, right? Like the ETH staking rate has been going anywhere from 4% flat all the way up to, I want to say, about 12% at peaks recently. Um, so like there's a lot of variability there. It continues to actually go down as more and more people stake, and that hasn't stopped and likely will continue post merge or post withdrawals. That likely will actually have more deposits. So this leaves a situation, like you're saying, where people that just want to avoid all of that bullshit and figuring out the math behind like how fast will things dilute, what's my optimal yield, all this, which really is kind of complicated. Instead, they can just stake at a fixed rate. They actually get their yield up front as well, which there's a lot of other cool, fun use cases there, right? Like if you just have a bunch of ETH and you want to go like buy a TV today, instead of selling your ETH, you can just sell off the future yield from it, right? In the same way that that honestly, if people are familiar with Alchemix, it's the exact same idea where they're selling your future yield, but for like an undetermined amount of time. With Swivel, you sell your future yield, and you actually know when you're going to get your money back, which is pretty nice. But yeah, sorry, sir. The best example then with staked ETH on the other end for people that are taking on risk is that they're doing something similar to a lot of old gas tokens, where they're just betting that more people will use Ethereum, and that's a really simple bet, right? And in those periods where you see the rates go triple from 4% to 12%, these people actually they make 300% on their position, right? Whatever the rate is that they paid compared to the rate that is actually being accrued, is their actual their profit. So we've had a few people in those periods earn, multiple hundreds of percent in a few days, which obviously that's not common. I don't want to necessarily like say that everyone should expect to make hundreds of percent immediately, but even in a bear market, and even let's say not this week because we've had finally some nice trading volatility, but for past months we had no volatility at all. There were still plenty of opportunities within the interest rate market to trade around and speculate there. So yeah, there is two sides to it. I do like to think that there's like that the most important people, even going forward, are going to be all of the devs out there that then make like the cool stuff possible. So I don't know. It's kind of hinting, I guess, towards what some of it is, but I don't want to just keep going. So if you had any more questions, my bad.
Yeah, I don't know if you can reveal it, but like, who are your partners, and what type of partnership do you do you have, or are you building to grow the I guess your protocol?
Sure. So first and foremost, I'd actually mention Illuminate, which is actually they're a partner protocol of us. I'd say they're a sister protocol in reality, which they're actually aggregating all fixed rate protocols, which is extremely important. There are a number of issues with actually building on fixed rates right now. In the same way, there are a number of issues building on options. Kind of there's fragmentation of maturities, there's fragmentations of liquidity, and a bunch of stuff like that. So I'm obviously like Illuminate is going to be a pretty large project. I'd like to look at it very similar to Yearn in terms of really what Yearn enabled for DeFi initially. So obviously they're massive, but then there's a lot of cool actual implementation projects of like actually completely new things. I'd shill Contango, which is a newly released project on Arbitrum, which is the first expirable futures project on chain, right? So expirable futures are similarly massive traditionally, right? You in traditional finance, they're obviously massive for commodity. They're pretty much the only thing that gets traded. There's no such thing as perps. But then more specifically, even on crypto exchanges, they get about, I want to say a few $100 billion a year in volume. And obviously that's significant. So what you get then when you move that on chain is the ability to perfectly route all of the lending positions on the back end for these futures. So what they're doing is, this is kind of complicated, so bear with me, but they flash loan DAI, they buy an ETH position with it, they take that ETH position, they lend it out and stake it at the same time so it earns additional yield. They use that lent out at a fixed rate position as collateral then to borrow DAI and then close the initial flash loan. And the result is that you have a position on ETH that expires and that executes at a future date. And this is huge, right? Stuff like that is huge. Other partners, I mean, there's degrees of these partnerships, so keep that in mind. But, we've got great friends across pretty much all of the options protocols. Dopex, Jones, Lyra, Premia, they're all friends. We've had them on for podcasts and et cetera in the past. And, that in itself already is an entire ecosystem. When we had Contango on for our podcast, they mentioned that the number one use case they saw for their expirable futures was the hedging of options. And all of a sudden, this creates like this really, really, really cool ecosystem where, well, you can provide better prices for options because you're getting better routing. This is just, you're getting better lending rates and better funding there. You have so there's better premiums. And then on the other side, because the people are earning better premiums, they actually sell the option leg of it for cheaper. So the people buying options pay less for their options. And then on the other side of this, that all of that is being backed by fixed rate lending on DeFi, which is being backed by the variable rate lending on DeFi. And on the other side of that, it's all being hedged by everybody that's using the options positions, or rather the futures positions that do the same thing. So like, there's a huge ecosystem there already, I suppose. I'd also just give quick shills for Frax and Euler, who were building a pretty cool new stack, which not just does the tokenization of lending, but the tokenization of staking and lending at the same time. And through all this, I don't know, like, I think that there hasn't really been as much exciting stuff in a while. So I'm excited. I'll just say this, we've done a private launch very recently of one of the protocols I mentioned. So you guys should be expecting to hear a lot more info soon, TM.
That sounds super excited. But I think you lost half of the room when you mentioned flash loans. Even myself trying to keep up. But and actually, like that raises a question because it does get a bit complex. When we talk about derivatives, interest swap, and then you mix it with like all the combination with all the financial primitives, the options, the flash loan, and DeFi. Do you think that the growth of your protocol is going to be based on developers using your protocol almost as a middleware, and then the end user not necessarily know how things work, but they see the access to maybe a cheaper notional position or a higher fixed rate? Or do you think there's going to be appetite for people to actually learn, educate themselves, and directly interact with the protocol?
I think you'll get a bit of both to an extent, and I at one point had a very strong perception that I wanted to be middleware. You know, you have a lot of companies traditionally that have established themselves well, but you know their moats aren't the largest because they don't have networks of liquidity like you can get in DeFi. But over time, really, I felt like this was also an opportunity to capture an ecosystem and to own a lot of the users within it, right? And I think what you need to do is distill a lot of that complicated stuff down from this larger vision, although like the larger vision is super cool, to what you can offer regular people, right? And each and every person in whatever it is they do specifically, you can offer them something better than whatever they're doing now. For the lender, you can offer them a better rate that isn't going to screw them, right? For the staker, you can offer them a rate that isn't subject to like complicated math and variability that you literally just don't understand. For the options buyer, you literally just get a better price on your option, right? Like that's something that is so easy to understand, right? If you can get a 30% discount on what you're paying for your option, there's almost no excuse for using Deribit anymore. There just isn't. Like, what are you doing? And similarly for futures and stuff, right? Like you have to talk to the user where they're at, and rather than trying to like onboard people to trading options, that's not going to be easy to do. Like you're saying, educating is difficult. We will have partners, we will be middleware, but it's also just like you can't speak past the user and specifically who they are and what they want, right? Like I'd even be interested. Are you guys options traders? You know, like who are you, Dow? I guess what do you think you are?
DeFi degen.
Yeah, exactly.
Yeah. Okay. Yeah. Then like you might be in there. Like you started talking about rate speculation, right? Like this is something that a lot of people just will not understand, even as much as you explain it to them. But the people that are in there and have seen how volatile the rates are will be like, well, shit, I can make a lot on this. Right? Like, especially when there isn't a large number of market participants, that's actually when you can make the most. And I mean, not just with us, like it's worth shilling. There's a larger space out there, and becoming established in one of those ecosystems likely not just establishes you as like profitable and a domain expert, but let's be real, there's enough people without released tokens out there that it likely gets you, you know, some position as well within some ecosystem. So like I in my opinion, there's no better time to be hunting airdrops and like looking for things than now. So that's what I've been up to, I suppose.
Yep, always on the search for airdrops. Queen, what's up? Go ahead, Queen.
Queen is dancing in her seat right now. So I agree with you 100%, Dal, about educating people as to using these products. Because I'm typically a person that when I hear about a DeFi product, if they have a token and I'm bullish on the product or the team, I'll buy the token, and that's about it. Like, I don't really use these products because I don't understand them. So one of the challenges when I started working at Swivel was how do we educate our users to understand how great of a product that this is and how it can benefit them, without just giving them, a big long document to read and hoping they get it. And that's why we've partnered with something called Crew 3, which you can see up in the pin tweet. We're going to be attempting here to onboard our users with Crew 3, which means taking you step by step through reading our docs, reading our light paper, using the protocol, following us on Twitter, like little social things and stuff that will help you to understand it over the course of a month. And of course, this is incentivized. So I'll read a little blurb about that in a second. But check out that pin tweet, because this is exactly the function of Crew 3. We're going to be attempting to create not only bullish users on the product, but bullish users who understand the product and aren't just bullish because Queen and Julian are involved, but are bullish because they now understand DeFi. And while really big gigabrains like Julian are working on making DeFi open and equitable from a code perspective, from an app perspective, it's kind of a passion of mine now to make it open and equitable from an understanding perspective. There's a huge moat around DeFi for people just understanding what it is they're being given. So really fast, this is an incentive that we have for our listeners today. At the end of this space, we're going to give out a password that'll be good for one of these quests. But let me read you a little blurb about what we've got going on with our ambassador program here. Swivel will be partnering with Crew 3 to host an onboarding contest beginning today, February 17th, 2023. During this window, users will be rewarded for learning our product with a completely unique incentive structure. Powered by NFTs, our top contributors gain access to long exposure on ETH via positions held on Swivel. By completing short and simple onboarding activities for Swivel, you'll learn our product through educational tasks while you're earning NFTs verifiably backed by ETH with simple daily quests. Hold your NFT to expiry to capture the full upside on your Ethereum position. Expired NFTs become soulbound, or sell the NFT on the secondary market for immediate access to your liquidity. So essentially, you're being paid in ETH longs to learn the product, learn about fixed rates, learn about DeFi, and help to bridge that moat between the DeFi user like me and the DeFi understander. That's my pitch. I was so excited.
No, I think that's a great point. Like, I know about DeFi, but I don't know a lot about fixed rates and traditional markets. And I'm sure like Tammy knows about the traditional side, but doesn't dive into the DeFi. So some people are split in the middle. Like, we only know one piece of it. So bringing it together and providing incentives for it, I think it's really cool. But getting back to Swivel, I heard you, Julian, mention that there are other protocols in the space doing this. So maybe let's talk about, like, what do you think is broken in the fixed DeFi space, and what are some of the things that Swivel's doing to address those problems?
Sure. So I'd say there's a lot broken, right? Like, just from some base mechanism designs to things like maturity choices. So something that, like, I mean, this is easiest to understand is something traditionally called IMM dates. And these are just like dates set by the International Monetary Market for all of the stuff to kind of mature at once. Right. So if you've got options and you're buying leaps, or yearlies, generally speaking, they're always going to mature at the same time, regardless of what asset you're buying, what brokerage you're buying it from, like everything. And similarly, you also have like your loans maturing at the same time, and pretty much every asset possible trying to coordinate their maturities. And this actually is what enables a lot of the hedging and the advanced financial stuff that goes on and fuels the 55 trillion swap market and really the options market and the futures market. All of these will completely rely on coordination, and none of that exists whatsoever in DeFi. So this doesn't just cover fixed rates, but like anything that matures at all. So really, again, like options, fixed rates, futures. I'm sure there's probably other stuff in there, but those are the main ones. And specifically then within fixed rates, you have about 8 or 9 protocols, and they all mature like 5 days apart from one another, which is so frustrating because it's like we kind of tried to coordinate, but we all said fuck it at last second and didn't actually, because that means that nobody can actually use these protocols other than in a complete silo. It's very disappointing. On the other side of this, I think similarly, there's a lot of issues with liquidity provision for both. Like, people are more aware of it with options, but pretty much anything that expires too, right? Or really just anything that's a derivative. You end up with an AMM that is trying to account for far too many variables that it doesn't really have access to for the most part. And situations where, I mean, similar to Hedgic, I don't know if you guys are familiar with Hedgic, but their historical data is not good. It's like each year their LPs were losing consistently about 15% of their capital. And of course, that's not sustainable. Like Molly Wintermuth's response for this, quite like literally, when questioned on, well, how are you going to sustain your liquidity as your users are just losing money? She said, well, I don't really care about that. Look at the data. Like the chart goes up and to the right, and we're shooting out enough tokens that they don't care about it clearly. That's not an acceptable answer. Similar things are really in place with the fixed rate market. I don't want to just like shit on any particular protocol, but there are a number of fixed rate protocols which rely on AMMs that have no knowledge of what the current rate is on, let's say, compound, right? So if you're trying to create a derivative on this compound market, you can't account for any changes in that rate. It's essentially like, imagine you created an options market and like you have an option for ETH and you're providing liquidity for it. And for some reason, your price doesn't change whenever the price of ETH changes. And you're sitting there quoting the same price, even though ETH has doubled in price. It doesn't make any sense, and it leaves the liquidity providers screwed. So we're trying to avoid all of this at Swivel. First and foremost, we've created some standards that should help on the coordination side. There's something called EIP 5095, which is a standard for principal tokens. It's not a word I've introduced yet, but it's essentially a standard for fixed rate protocols to ensure that they're all actually possible to integrate with. And another then is a DeFi native IMM date. I'm going to be honest, Binance kind of controls this at this point because everyone just has to synchronize with their maturities. But stuff like this actually will enable cross-platform activity, right? So up until now, there's only been people trading on one options platform and trading on one fixed rate platform, and you can't really do anything across them. In the future, really, not just future, just pretty much in the coming month or two, this will really change as maturities sync up and people kind of work together. And the final thing I'd just say is like, yeah, then on the topic of these liquidity providers losing money, we at Swivel, I kind of admit that there's just is no proper way to provide liquidity for derivatives right now on chain. So we utilize an off-chain order book, right? It's a model very similar to 0x, if anyone is familiar, and it allows our liquidity providers to kind of avoid all of those risks and actually consistently place orders at a much more efficient price. So at any given point in time, we generally speaking price the best and have, I mean, it's really lame when people put like 100x better capital efficiency numbers, but like significantly better capital efficiency, right? For every $100,000 on order book, it's likely equivalent to about 2 to 3 million on any AMM. So yeah, that's how we're fixing it, at least for now. There's a lot more in there. I could probably talk about how DeFi is broken for hours. So yeah.
Nico, did you hear that? Standard, man. He said the word standard. Now I'm playing. I'm trolling a little bit, but I think that's a great point. So, what was the name of the standard or the numbers?
EIP 5095. It's the principal token standard. And the idea, again, is just that there's a number of different ways that people have done fixed rates. However, they all utilize one common mechanic, this principal token, which represents your deposit at maturity. And that can be unified across all these different protocols. You know, we have worked together with about 10 different protocols on this initiative. And everyone is implementing different versions of it in the coming month or two. Ours are already live. So that's extremely important. And similarly, the IMM dates, like it actually cannot be overstated how much this will change the environment for both options and fixed rates.
Yeah, I think that's massive that you mentioned that. And maybe that's a question or a statement. I'm not sure what that will be, but in my opinion, right, when we look at the space, most of us here because of two standards. The first one was the ERC 20 that got like the ICO boom era. So if you jumped in 2017, 18, that's probably why you're here. And then the ERC 721 for the NFTs. The whole crave around the crypto kitties and everything that came after that, in my opinion, is because of those two standards that most of us are here in this room. And I know there's another standard for Volt, right, that people have been raving on. And I'm looking at your JavaScript library. You have this ERC 4626, right, that basically means that, you know, if you have a Volt with a yield from Aave or Compound, they implement it differently. So if you're trying to interact with them, you actually have to read the smart contract to understand how to play with them, how to work with them. And for any developer, any protocol, that's a lot of work, right? Especially as we're growing in DeFi and there's like 5 or 6 different protocols that you need to interact with, each with their own implementation. If they all were to adopt ERC 4626, right, for a protocol like Swivel, I can imagine that would make your work a lot easier. So do you think that in the same way that ERC 20, ERC 721 made quite a change or a shift in adoption for the crypto space, do you think there is a similar narrative for a standard? Maybe it's the standard you mentioned for a fixed interest rate or for Volt standard. Do you think that there's something about that for, you know, really opening the adoption floodgate?
Yeah, like perhaps not to the same massive degree that like ERC, like the base level, like unique assets and fungible assets do, right? But like the point of ERC 20s alone is just like extremely important to bring up. There are not a ton of people that have been here since like 2015, 2016, 2017. But those who have will recognize that a lot of early ERC 20s didn't actually conform to the ERC 20 standard. They were just called tokens at the time. And this actually led to and still results in a ton of headaches and problems for anyone that actually wants to build. The best example currently is Tether, which has like a bunch of random interactions in it, and they can't change it because it's the only unupgradable large contract there really is in DeFi. But beyond that, there was constant issues where if you really wanted to build a protocol, you had to account for like, oh, well, he might not have returned a true when the transfer works, like, or false when it doesn't. It might just like fail, right? These are things, or it might not fail. It will just return true or false. These are like random things that seem like they won't be a big deal, but completely change the way that a developer has to look at things. And like you're talking about, and a big shill for 4626. I actually also helped write that too. 4626 like is extremely important for the growth of DeFi more generally, and similarly 5095 will be for fixed rates, and hopefully as well options and the proliferation of other derivatives. But 4626 already has been impactful for us. We've already been able to integrate with every single thing that Frax releases, because Frax also helped write the standard and was the first protocol to release anything significant on top of it. So this leaves us in a situation where we're actually able to do some even cooler stuff, which is like we've pre-created a stack that allows us to multiply different 4626 vaults together. So if you have like a 4626 vault, which can be deposited into another 4626 vault, like, which actually there are use cases out there for this. For example, Frax ETH on top of Frax Lend, it would be one, or Frax ETH on top of Euler. You can do a lot cooler stuff, and there's no effort from our end anymore. This is even let's say if the code only takes a day to write, there's massive coordination effort that one would have to go through to actually release that code. So when you start to implement these standards, and you can actually just use code that's already been deployed, people actually just start to build so much more, so much more. Like you said, with ERC 20s, people actually started to build exchanges, right? With ERC 721s, people started to build games. I think that would be the bigger example of where people have started to go. And without these standards, you would just have like, I have to integrate a Fidenza. Oh, now we have to integrate Bored Apes. Like, these would all be completely different projects, and everyone would be likely years behind.
Yeah, that's really a great point. I know Dow brought that up because we had a debate about standards and non-standards on Bitcoin, but that's a great point. Yeah, it definitely lets people enhance on the functionality versus, trying to build the foundation. But I do know we are coming up at the hour, and I do want to be respectful of your time. So I wanted to give a chance to Queen to maybe, is there anything that you want to leave us with before we wrap up? Anything that we missed? I want to make sure to give you the time to be able to share that.
Thank you so much. And thank you, everybody that's in this space right now, for listening to us, for hearing us out. I love these kinds of spaces because they just make me feel more entrenched into the ecosystem itself of DeFi and crypto. So thank you guys for being here. Follow all the great speakers up here. And if anybody has any questions for Julian, I think if we have a few minutes, you can request to speak and see if we've got time for that. But the biggest thing is that password that I promised you. If you head to our bio at Swivel, you can find a link to our Discord. And for today only, we'll be giving out the Distinguished Swivelian role as a thank you for listening, which will unlock a bonus quest path for you on Crew 3. And again, Crew 3 is how we're going to be turning DeFi users into DeFi understanders. And the password for that, if you head to Crew 3, you'll see at the very top, there's a crypto and coffee space quest. And the password is going to be Jess, Jess. And it's named after our host. And just thank you again, Jess, for having us. Thank you so much for having us on. And head over to Crew 3, head over to Swivel, and become a part of DeFi.
Queen, can I just say one thing really fast? Because your tweets are protected, I know you said that you did pin at the top. I can't see it. So I don't know if you want to send it to Jess and maybe Jess can put it up there. I just want to make sure everybody can participate in what you said you pinned.
Oh, of course. Sure thing. I'll DM those.
I tried pinning it as well. Let me know if you could see it, Tammy. Yeah, if anybody has any questions, feel free to request to come up. But I guess last thing, Julian, what are you hoping to see evolve or change? What are you most excited for in DeFi this year?
Ooh. Obviously I've talked a lot about the option stuff. So like that is important, right? Honestly, like outside of things being built, I'm just most excited to see what actually happens with the merge, or rather the withdrawal period, right? This has been something people have been waiting for, upwards of 6 years, depending on who you are. And it's very exciting. And I'm then most excited after that for everything that will actually be built on top of it. There's a lot of cool ideas, I think, from other ecosystems that haven't been tried on ETH yet because we haven't really had access to liquid, this is horrible, liquid staking derivatives, in that actually liquid derivatives that you can access in and out without actually worrying about the price for. So an example actually horribly would be Terra, where they at first tried to create a stable coin that was largely based around the staking rate on Luna. And this was before they turned to like ridiculous tokenomics with Anchor and a bunch of other things. But the bottom line was that Anchor was designed to utilize the staking rate and redistribute it to people that had staked their stable coins. And really cool things can be done like that, right? Like you can utilize platforms to capture all of the yield that's actually natively being generated on ETH, and then create really, really cool stuff like stablecoins, like unique new derivatives, like let's say fixed price transactions. That's something that we're working on ourselves, although it's really early stage. There's just a lot there to be done. If I'm going to say there's one specific product I'm excited for, it is going to be like the principal token backed options, which would be equivalent to a bond backed option in traditional finance, which doesn't really exist. In that, you can do two things at once. With options, you're trying to sell volatility to somebody else for some yield. With interest rates, with us, you're essentially just selling your interest rate volatility to somebody else. And you can do both of them at once, which is not something you can do traditionally. And in doing so, you create a really cool market, right? As the person selling options, you're just earning more premiums. You're earning likely 30% more premiums. And then as the person that's actually receiving or purchasing the option, well, the person selling it to you is obviously making more overall. They're going to sell it to you for cheaper. So there's this great situation where it's actually all players seemingly winning out. And honestly, that to me is what onboards people to DeFi, right? It's really, really cliche. I'll keep saying it. But the thing that founders normally say is you need to take a product and offer a 10 times better experience to onboard them to yours off of that. And honestly, I don't think much of DeFi does that until you start to offer things that's it's a simple value proposition. If you just get things cheaper than you otherwise would.
Great points, and well said. Yeah. Thank you so much, guys, for coming. We're going to keep it going here. You guys are welcome to hang out or drop off. You know, you guys are very busy, but I do really appreciate you coming here and just letting us learn. I learned a lot of things that I didn't know, and I'm looking forward to dive in more into that ecosystem. But yeah, I really appreciate you guys coming by.
Thanks for having us more than anything. And so it's just fun. I checked in last week and hung out, and I'll be here from now on.
Thanks so much, Jess. Thanks again for having us.